Welcome to the Financial Times. I'm Vivianne Rodrigues, a capital markets correspondent, and I have Sabur Moini from Payden Rygel, a high-yield bond portfolio manager, who is going to chit-chat with us a little bit about high-yield bonds. Sabur, high-yield bonds have had a tremendous rally,
right.
A multi-year fantastic gain. But there was a bit of a hiccup or a bit of a scare in the last couple of weeks.
Right.
And I wonder, as a portfolio manager, was this, really scary? I mean, is this the beginning, perhaps, of a more broad-based sell-off in high-yield bonds, or it's just a minor correction, you think?
Thank you. We think this is a minor correction. The market's had a very strong run. Through June, it was up for 10 straight months. I think, of course, everything valuations maybe got a little bit stretched. You had a confluence of geopolitical volatility, and I think selling begets selling. So you had some selling initially in early July, and that beget more selling. We think valuations now are compelling, and we think this is a good point for high yield. Valuations are back to where they were late last year. So we think, again, that's a good entry point given the strong fundamentals of the market.
So basically what we have here at the beginning of July was we had Janet Yellen's comments that valuations were stretched, prices were super high. I think yields touched record lows in June.
Yes.
I mean, if we were to measure, I'm not sure even if we can, to measure the type of correction we've seen prices, fall, what, 3, 4, 5%? I mean, in about 1 week or 2 weeks?
Sure. So broad high yield indices in July were down about 1.5%.
Okay.
Now, some high yield bonds were down more, some a little bit less. So it varied. But the market certainly was down. And much of the damage was done really in the last day of July and the first day of August because there was significant selling. That seems to have subsided. I think people are realizing valuations are compelling. So I think what you're starting to see now is money coming in. Unlike past sell-offs, this was not a risk-off environment. This was really concentrated within high yield. And we think that people who were nervous about the market and were concerned about valuations, they've exited the market. So we feel that the high yield market is 1.4 trillion in size. So even this 5-6 billion of outflows is relatively small within the context of the broad market.
So in your particular case, or in your funds, you're still very vested, you like high yield a lot, you told me this before.
Right.
Do you consider this as a good opportunity to come in and buy other bonds at a particular more interesting price points? And which areas of the high yield market do you think now are very attractive, especially after this sell-off?
Sure. So as we discussed a little earlier, a number of bonds are off 2 or 3 points. So and yields are significantly higher than they were 2 or 3 weeks ago. So we feel this is a good buying opportunity because the fundamentals remain good. So in energy, a number of bonds are off 2 or 3%. In telecom, again, sectors that have historically done well and that are considered a little more stable and defensive that we still feel should do well. So with energy in the US, with the whole fracking, the renaissance of energy, we think it's a good opportunity. In healthcare, with the Affordable Care Act, so-called Obamacare, we think that's a positive, especially for high-yield hospital operators. We think that's a good opportunity. So we do feel valuations are compelling in energy and healthcare and telecom are 3 sectors that we think.
So what is high yield in high yield these days? Because even
Right.
people joked a lot that the high yield should not longer be called the high yield asset class. But are we talking 6%, 7%?
I think, yeah. So prior to this mini sell-off that we've had, for broad indices, yields were sort of in the low to mid 5s. Now they're in the sort of low 6%. So 6% I think is a fair yield given the low rate interest environment we're in. So as long as we remain in a low rate environment, which we think we will for some time, 6% type yield is fairly good. It's not 8, 9%, but that was also a number of years ago. But with the 10-year U.S. Treasury 2.5, if you can get 6% on a high yield bond, we think that's fair valuation.
But one of the big concerns throughout even the sell-off and the fact that valuations may have been stretched is because people started to notice that maybe having yields at 5 or 6% would no longer compensating investors for the risk attached to some of the securities, specifically in the lower, more speculative portions of the market where people were buying CCC bonds and very few covenants, very few protections. Do you think this people are a little bit more mindful about this particular corner of the high yield market, or is still is it still going to keep booming and people just really are not afraid of defaults or leverage in companies that do not have a very strong balance sheet?
Right, good question. So default rates are near historic lows, right? So the default rate is around 2% right now. Historically, defaults have averaged around 4.5% if you look at different cycles. So I think that also gives the investor base confidence that the outlook for high yield with defaults likely low for some time to come, I think people are willing to take a little more risk. Now, sometimes markets get extended. So I think we at Payden Rygel have been a little bit more cautious and focused more on the double B and single B rated portions of the market, and less so on the triple Cs. I think there's some value in triple Cs, but I think you have to be careful. The lower down you go in quality. Same thing with bank loans. The more aggressive bank loans you look at, or covenant light deals, again, you have to be cautious. So I think the Fed's low rate policies have maybe pushed the markets a little bit too far, but I think the higher quality end of these markets still remains quite compelling, to double B and single B portions of high yield.
Thank you so much, Sabur.
Pleasure. Thank you so much.